During the previous week, the rupee remained broadly stable and traded in the range between 72.85 to 73.05 on most of the days in the week, the high and low being 72.74 and 73.11 on Monday and Thursday last week. Despite the rise in U.S. consumer prices, the 10-year yield slipped back to 1.43% amid signs that traders are continuing to unwind short positions. Despite the higher U.S. CPI inflation print, the rupee stayed stable amid the rise in global stocks. The BSE sensex surpassed the all-time high of 52,516.76 in the early hours of trading on Friday and well set to record new highs in the coming weeks. During this month till date, the portfolio equity inflows have exceeded more than $2 billion against a combined equity outflows of close to $2 billion in April and May 2021. The capital inflows arising out of divestment and IPO-related inflows would lead to a test of 72.30 resistance level of the rupee, and only the RBI intervention could balance the position in the market and stabilize the rupee. With the lower forward dollar premia levels up to 3-month maturities, importers can take advantage of hedging their payables at a favorable forward exchange rate. The current spot and forward rates favor the importers and opens up the possibility of keeping the payables unhedged to save on the hedging cost and to derive the benefit of rupee appreciation in the interim period. Despite the rise in U.S. consumer prices, the 10-year yield slipped back toward their recent lows amid signs that traders are continuing to unwind short positions. The sheer flood of cash coming into short end markets is also a factor potentially supporting demand for treasuries, which even at these levels offer more yield than many alternatives. The 10-year T-bond yield declined below 1.44%, the lowest in more than 3 months. As of 28/5/2021, the country's forex reserves rose by $5.306 billion to $598.2 billion. The huge accretion in reserves represent the inflows from IPOs of Indian companies, QIPs, FDI, and huge increase in external commercial borrowing by corporates besides other capital inflows. RBI Governor announced on Friday last week during the central bank's policy announcement that the forex reserves may have exceeded the $600 billion mark. The accumulation of forex reserves reflect the strength to the country's balance sheet and underline the stability and orderliness in market conditions. The significant rise in forex reserves will help the rupee to recover all its recent losses and lift the currency higher to trade in the range between 72.70 to 73.30 over the next 1 month period. The steep decline in forward premia up to 3 month maturities and the favorable spot exchange rate provides the best opportunity for the importers to hedge their payables by gradually increasing the hedge ratio against the underlying import payments. Keeping the short-term payables unhedged without fixing a target level can prove to be an imprudent strategy in the background of rapidly changing scenario in the local and overseas markets. With the rupee exchange rate remaining broadly stable and the forwards up to 6 month maturities are currently trading in the 4.00 to 4.45% per annum, the importers and exporters can target to hedge their exposures at a favorable forward exchange rate to enhance the export realization against receivables and minimize the exchange rate losses against import payables. The trade credit facilities availed by the importers will have the cost benefit of over 3% per annum in rupee terms on a fully hedged basis. The World Bank has projected India's economic growth for FY 2022 to stand at 8.3%, the lowest forecast so far, and quite close to the GDP growth forecast of 7.9% projected by SBI for FY 2022. These economic forecasts are to be viewed in relation to the growth contraction of 7.3% registered in financial year 2020-21. We expect the rupee to depreciate by not more than 4% on an annualized basis over the closing level of 73.1050 as of 31/3/2021, indicating a spot level of 76.00 to 76.30 at the end of March 2022. The huge position of forex reserves would ensure the depreciation in the domestic currency in FY 2022 not to exceed 4%, which is also the inflation differential between India and our major trading partners.